Okay, let's dive right into this. Welcome to today's Explainer, where we are talking about escaping the cash illusion. We're going to break down 6 distinct asset classes, side by side, based entirely on their risk and potential returns. The goal here? To figure out exactly how to protect your wealth from inflation and effectively match your investments to your personal risk tolerance, especially if you're a conservative investor looking for a safe harbor.
To kick things off, we really need to address one of the biggest lies banks tell us. You know the one. They say that keeping your cash safely tucked away in a savings account means your money's growing. Well, there's a powerful quote on screen that perfectly captures reality. Your balance might be ticking upward by a few pennies because of interest, sure, but in real terms, in actual everyday buying power, it is a completely different story.
You see, when we contrast these two forces, the whole illusion just shatters. On one side, you have your standard nominal bank interest, which is lagging way behind. On the other side, you've got soaring inflation ripping right through the ceiling. So keeping all your cash in the bank isn't actually a safe haven at all. Actually, scratch that. It's practically burning a hole right in your pocket.
So here is our roadmap for today. 1. The cash illusion. 2. The conservative core. 3. Tangible wealth hedges. 4. Engines for higher returns. 5. The high-reward wildcards. And finally, 6. The risk and return matrix. All right, starting with part 1, the cash illusion, and why traditional banks are failing savers right now.
The core of this issue actually dates all the way back to 1971. That was the year President Nixon abolished the gold standard. Since then, the dollar in your wallet is simply a fiat currency. It has absolutely zero physical gold or silver backing it up. It's just legal tender by U.S. law, which means its value relies entirely on the full faith, credit, and stability of the government. So when governments print more money to finance their deficits, that piece of paper in your pocket literally loses its value.
Moving on to Section 2, the conservative core. Let's look at the absolute safest alternatives to cash.
For our most risk-averse viewers, the foundational concept you need to know is the sovereign guarantee. Basically, a stable national government is always the absolute last entity in a nation to default, right? Because if they default, the whole country goes down with them. So investments backed by an investment-grade government are incredibly secure. We are talking about U.S. Treasury bills, notes, and bonds. They offer much better returns than standard bank cash, with massive security.
So if you're a conservative investor looking to flee cash, you really have 2 elite options here. On the left, U.S. Treasuries, which literally anyone can buy directly through the government's Treasury Direct portal. Pretty easy. On the right, safe haven currencies, specifically the Swiss franc. Switzerland has an incredibly strong economic system and amazing geopolitical stability. I mean, during the Eurozone debt crisis, the 2008 financial crisis, and even recently with the Russia-Ukraine conflict, massive global funds just fled to the Swiss franc. When Russian energy trades pivoted to Swiss francs, early 2023 saw the currency tremendously appreciate against the dollar, and honestly, the best part, you don't even need a fancy Swiss bank account. You can easily access this protection through currency ETFs with as little as $100.
Okay, Section 3, tangible wealth hedges. Stepping slightly up the risk spectrum here.
$10,000. Let that number sink in for a second. Before the 1950s, an ounce of gold was about $400. In 2023, it crossed $2,000. But Prime XBT forecasts that the price of an ounce of gold will hit $10,000 by 2032. No way, right? But that means in roughly 10 years, gold investments could be 5 times what they are now. And it makes sense because governments can't just magically print more gold. It is incredibly scarce. So, while cash goes down in value, precious metals go up.
Yeah, you might be thinking, I don't have millions of dollars to buy bricks of gold or massive apartment buildings. Well, you don't need to. For gold, you can just buy gold ETFs, which completely removes the headache of physical storage or finding a buyer later. Then there's real estate, right? A truly non-depreciable asset because we are always going to need land for homes and hospitals. Fun fact, housing prices actually tripled between 1992 and 2020. And again, you can gain exposure easily through REITs, that's real estate investment trusts, like Ventas Inc., which specifically invests in healthcare real estate. Or you could borrow to own rental properties where your tenant's rent effectively covers your mortgage while you just sit back and build equity.
Section 4, engines for higher returns. Sometimes, beating inflation means tapping into global industrial demand.
And this chart brilliantly illustrates exactly what I mean. Take a commodity like cobalt. In 2012, it was sitting at $20,000 per ton. By 2022, it skyrocketed to $40,000. That is a 100% increase in just 10 years. Why? Well, it's all because of the massive electric vehicle boom. Metals like cobalt, nickel, and copper have huge natural utility, and they can't be easily replicated. To capture this kind of growth, everyday investors can look at stocks of mining companies, or even mining-focused mutual funds.
Now, speaking of stocks, we really need to clarify a crucial distinction, especially for our risk-conscious viewers. The stock market broadly divides into value stocks and growth stocks. Growth stocks, like a lot of the companies in the tech sector, deal in brand new ideas. They have high failure potential, which means much higher risk. Value stocks, on the other hand, like the industrial metal company Nucor, have established demand and offer steady, reliable dividends. So, if you want market returns without the extreme heart-pounding volatility, dividend-focused mutual funds like the Vanguard High Dividend Yield Index Fund are just fantastic, stable ways to step up your returns.
All right, Section 5, the high-reward wildcards. Let's look at the absolute pinnacle of the return spectrum.
We are talking about alternative assets that operate on extreme scarcity. Collectibles, vintage cars, rare art, luxury handbags, limited edition watches, first edition books. Think about a regular car for a second. You drive it off the lot and it instantly depreciates by half, right? But the math works in reverse for vintage collectibles. They act a lot more like fine wine. They become these timeless repositories of immense value.
$450 million. That is exactly what a Saudi prince paid at a Christie's auction for Leonardo da Vinci's controversial painting, Salvator Mundi. $450 million! And it's not just art, by the way. In 2022, a 1955 Mercedes coupe, one of literally only 2 ever produced, sold for an eye-watering 135 million euros. But hey, don't worry. If you don't have a royal budget, you can still participate. You can start small on online marketplaces like Whatnot to buy and sell rare comic books or action figures. Or, even cooler, you can buy fractional, partial ownership of high-end, multi-million-dollar collectibles through platforms like Convey and Masterworks. You can literally own a tiny slice of a Picasso or a Rolex.
Let's move to our final section and see how this all builds together. Section 6, the risk and return matrix.
So, looking at this matrix, the absolutely crucial point is understanding where you fit in. If you are a conservative investor fleeing the cash illusion, the ultimate winners for you are sovereign guarantees like U.S. Treasuries and safe haven currencies like the Swiss Franc. They offer low risk and unmatched security. But if you want steady returns with medium risk, look to the tangible hedges of real estate and precious metals. For growth, look at value stocks and commodities. And of course, if you have the stomach for high risk and high reward, collectibles are your ultimate wildcard.
Which brings us to the most important question of this entire explainer. Which asset class on the spectrum best aligns with your personal risk tolerance today? Look, the days of just blindly trusting the bank to grow your wealth, those days are over. Inflation is very real and the cash illusion is fading fast. It's time to take deliberate action, optimize your portfolio, and put your money into assets that actually hold their value. Thanks so much for joining me on this deep dive, and I highly encourage you to start exploring these asset classes for yourself today. So what's your first move going to be?